Come to the next question. Okay, keep calculator ready, be little active. On 20th January 2015, X Limited purchased goods from US supplier amounting to US dollar 20,000, which is settled on 2nd July 2015. The reporting date is 31st March. So in this question, you have to pass entry on 3 dates. 20th January for purchase, 31st March for change in exchange rate, and again on 2nd July for settlement. And you can see the rates are changing, so exchange difference will arise on these 2 dates. So first let us understand this problem. This I have written in your notes. The date of transaction is 20th January 15 when the rate was US dollar 1 equal to 61.6758, and then on the reporting date the exchange rate is 62.5300. So between these 2 dates there is some exchange difference. Check the calculation. 62.53 minus 61.6758 into 15,000. Is it 12,813? Right? Okay. And then between these 2 dates again the rate have changed. Again just try 63.5845 minus 62.53 into 15,000. Is the answer 15,818? So if you can do this fast, then my task is easier. Come to journal entry. Date 20th January. Purchase account debit to trade payable account. Multiply 15,000 into 61.6758. Is it 925,137? Tick mark. Or write down first, then tick mark. 925,137. And then 31st March 2015, exchange fluctuation loss account debit already calculated in the previous page, 12,813, correct? And immediately you transfer it to P&L account debit to exchange fluctuation loss 12,813. This completes the first year entry. Now let us come to second year. In your notes, first what they have done, they have calculated the exchange fluctuation loss and passed one entry, exchange fluctuation loss to trade payable. Is it 15,818? Already calculated. And then you make the payment. Trade payable to bank. Calculate 15,000 into how much is that rate on 2nd July? 63.5845. Just multiply 63 into 5, 63.5845 into 15,000. Are you getting 953,768? Is the answer right? And what will you do with that exchange difference? At the end of that year, 31st March 16, P&L account debit to exchange fluctuation gain account. Is it gain or loss? Loss. Only here it is written gain. Yes or no? So you make it loss. Is it 15,818? Okay, very good. Now solve this question. 13 number. A company had imported raw material worth USD 50,000 on 15 January 2018 when the exchange rate was rupees 46 per US dollar. The company had recorded the transaction at that rate. The payment for the import was made only on 15th April when the exchange rate was 49 per USD. On 31st March 18, rate was 50 per USD. Company passed an entry on 31st March 18, adjusting the cost of raw material consumed for the difference between 49 and 46 per US dollar. So there are 2 errors. Spot 2 errors. Exchange difference is adjusted in cost of material consumed. Did I tell you that it has to be treated as an expense or an income separately? Second mistake, they have taken the difference between 49 and 46 per USD. 49 and 46, which is also wrong. At the end of the year, the rate was 50. So the standard says you have to apply the closing rate for a monetary item. Unless it is unrealistic, but it doesn't seem to be unrealistic on that date. Okay. Nowhere in the standard they say event after the reporting date you have to see to calculate the rate. Okay. So the answer is first, the foreign exchange difference should not be adjusted against cost of material. It should be transferred to P&L account. In the next year, the company would record a gain of rupee 1 per dollar. One more line right down. The closing liability should be valued at closing rate. Closing liability should be valued at closing rate. As per IAS 21. As per IAS 21. Okay. Come to next question, 14. Goods purchased on 24th February 2015 is US dollar 10,000. So that day the rate was 46.60. Exchange rate on 31st March 15 is 47. Date of actual payment is 5th June. On that day rate is 47.50. Calculate the gain or loss for the financial year 2014-15 and 2015-16. So we can answer in the form of journal entries also. Is it right? Like first entry will be on 24th February 15. Or you can do the mathematical calculation. Purchases account debit 10,000 into 46.60. Is it 4,66,000? Say yes. Trade payable 4,66,000. Then second entry on 31st March 15. Exchange difference, in bracket write P&L account debit to trade payable, in bracket 10,000 into 47 minus 46.60. Are you getting 4,000? 4,000. Then next entry write 5th June 15 trade payable account debit. What is the balance in trade payable account? 4,70,000. 466 plus 4. Exchange loss or exchange difference, P&L account debit now 5,000. Is 5,000 right? 10,000 into 47.50 minus 47. And to bank account 4,75,000. Next question number 15. 95% answer I have printed. Only you have to try your luck for rate and amount. AS Foundation Global, whose functional currency is pound, has purchased goods worth 2,50,000 euro payable after 3 months from Blitterjag company on 15 November when the rate of exchange was euro 1 equal to 0.60 pound. The rate of exchange at the date of reporting period 31st December is euro 1 equal to 0.65 pound. Required, how will the trade payable be recorded by AS Foundation Global? So only you have to tell me which rate you will use and what amount you will use on 15th November 16. IR means initial recognition, okay? SR means subsequent recognition. Come on. Check the answer, those who have done. On 15 November, we will take 0.60. And what is the amount you have written? 1,50,000? Or have you divided by 0.60? Multiplied? Sure. Okay. And what is the closing rate you have taken? 0.65? Have you got 1,62,500? Note, as the trade payables are monetary asset, liability, right? As the trade payables are monetary liabilities, they will be recognized at the end of the reporting period, at the spot exchange rate at the end of the reporting period. Next question. And all the exchange difference that we are getting will be transferred to profit and loss account. That note you know now. 16. Fair play publishers whose functional currency is pound publishes books in France. On 4th September 16, it has paid euro 30,000 to its publishers when the exchange rate was euro 1 equal to 0.70 pound. However, no work has been done by the publishers up to 31st December, that is the end of the reporting period, when the rate of exchange was 1 euro equal to 0.65. How will the prepaid expenses be recorded by fair play publishers? So first you will try, then I will try. What is the answer? 21,000 on 4th September. And what is the answer on 31st December? 19,000. It is a prepaid expense. It is a prepaid expense, non-monetary item. Is it right? So the answer is same. And there is a note also given. You should have read the note. As the prepaid expenses are non-monetary asset, they are recognized in the subsequent statement of financial position at the rate of exchange as on the date of original transaction. Now come to 17. Perfect International is situated in Germany and raises bills and makes expenses primarily using euro. On 12th October, it has purchased goods worth 40,000 pounds from Deliberate Inc. of England. 50% of these goods are included in the inventory of Perfect International. The net realizable value of these goods is 21,500 pounds. The rate of exchange on 12th October is 0.73 pound per euro. On 31st December is 0.65 pound per euro. At what value the inventory will appear in the SOFP? 50% inventory is held by you. 50% means 20,000 pound. So your primary economic environment is euro, okay? So you will convert into euro. Compute cost or NRV, whichever is lower. Okay, check the answer. we have inventory of 40,000 divided by 2, 20,000. So its cost would be based on the rate of exchange on the date of purchase. The date rate was 0.73 pound per euro. So convert 20,000 pound converted into euro. How much did you get? Did you multiply or did you divide? Oh, some people are clean bold. They multiplied. Pound is expensive. So more euros will be required to get a pound. Is it right? So did you get 27,397? And 21,000 pound is equal to how many euros? 33,076 euros. Okay. So sometimes the students make mistake for the small thing and they lose marks. Question says 1 euro is equal to 0.73 pound and you are given 20,000 pound. So it is equal to question mark how many euros? So 20,000 into 1 divided by 0.73, cross multiplication rule. Is it right? Same thing for this 0.65 also. Now inventory is valued using IAS 2. Cost or NRV, whichever is lower. Now very interesting thing they have mentioned in the standard also. If you compare their pound values, NRV is higher. But if you compare their euro values, oh, euro is higher here also. So we'll take 27,397. But sometimes it happens that after conversion, the situation may change. We will have to compare the figures after conversion. Okay. In case if the result is opposite, you have to take this column for the final answer. So the answer is 27,397 euro. Okay. Okay. Try your luck for this question number. Next. Quickly, 30 seconds. AS Foundation Global, whose functional currency is pound, has purchased land worth euro 1,25,000 on 1st July 2015. The fair value of the land was determined at euro 1,40,000 on 15th October 2015, euro 1,90,000 on 1st November 16. Exchange rates are 1st July, 15th October, 31st December, 1/11/16, 31/12/16. Make it 16. 31/12/16. Question is, determine how land will be recognized initially and on the subsequent reporting period. Assume cost model is followed. Underline assume cost model is followed. Now solve. On 1st July 15, initial recognition, you will apply the rate of exchange on the date of purchase. What is the answer? One lakh. Sure. This time you have multiplied. Sometimes you multiply, sometimes you divide. Be careful. What about the answer on 31st December 15? Same answer? Yes. So what is the correction required in your note? Here. So the rate used right down is the rate on the date of purchase. Rate on the date of purchase. If cost model is used, then for all the 3 dates, we will apply the rate on date of purchase. We will not change the amount now. Same ditto sign. Is it right? And there is a note also written below. As the land is a non-monetary asset, it is recognized in the subsequent SOFP at the rate of exchange as on the date of original transaction, that is on the date of purchase of land where the cost model is used. If the revaluation model was used, then the rate prevailing on the revaluation date will be used. Okay. Now solve this next question. On 1st April 2016, Fortune International, whose functional currency is pound, had purchased a non-current asset for euro 40,000 when the rate of exchange was 1 euro equal to 0.67 pound. It was revalued on 1st July 16 for euro 41,000 when the rate was 0.70. It was sold on 1st October 16 for euro 45,000 when the rate was 0.60. Determine the profit or loss on the transaction and state how it will be recognized in the books. Ignore the depreciation. First table you will complete. What was the value of this asset on the date of purchase? What rate you have used? 0.67. Have you multiplied or divided? So what is the pound value? 26,800, correct? And then you will revalue it on 1st July 16. What is the rate on that date? 0.70. Again multiply. So it is worth pound 28,700 now. Is there any appreciation? Yes. How much? 1900. So you will write a note, profit will be transferred to revaluation reserve 1900 pound. Now come to the date of sale. Carrying amount is 41,000 in euro and 28,700 in pound. When you sold it for 45,000. But that date, the rate has changed to 0.60 pound per euro and its pound value is 27,000. Loss or gain on sale? Loss of 1,700 pound, and the loss will be recognized in penal account. But you have some balance lying in revaluation reserve. Hello, balance lying in revaluation reserve. Where will you transfer it? To retained earning account on the disposal of that asset. Will you be able to write like this? Yes. Okay, now one important question. Is this question there in your book? It is towards the end. Towards the end. Question number 31. Yes. 31 number. 31 number. Entity A's functional currency is rupees. It has a building. Question 31. It has a building located in US, acquired at a cost of USD 10,000 when the exchange rate was USD 50 rupees per dollar. Building is carried in the books at cost. Depreciation is ignored. On the reporting date, there is an indication of impairment of the building. Okay. Consequently, an impairment test has been made in accordance with IAS 36 as at the reporting date. And the recoverable amount of the building is determined to be USD 9500. The exchange rate is 55 rupees per USD. So the treatment. Now this is an important question. See, when you purchase the building 10,000 into 50, so your book value is 5 lakh. You are finding that there is an indication of impairment because its USD value has gone down from 10,000 to 9,500. But when you multiply by this 55 rupees, check how much is that? Little more than 5 lakh. So will you provide for impairment loss? No, because we have to see after conversion into functional currency, is there an impairment? If the answer is no, no impairment loss needs to be provided. So this time we are getting conflicting signal. In dollar, the signal or the status is that there is an impairment, but in rupee value, there is no impairment. So right, the cost of building on the date of acquisition, the cost of building on the date of acquisition at functional currency is equal to, write in notebook neatly, 5 or 6 answers we will write in notebook. 10,000 USD into 50. Is it rupees 5 lakh? Yes, very good. Now write down recoverable amount translated at the exchange rate. Translated at the exchange rate on the reporting date. Translated at the exchange rate on the reporting date. You will multiply 9,500 USD into 55 rupees per USD equal to rupees 522 500. So your note will say that though there is an impairment loss of USD 500, though there is an impairment loss of USD 500. Why USD 500 impairment loss? Because there is a difference of 10,000 minus 9,500. Though there is an impairment loss of USD 500 in terms of foreign currency, there is no impairment loss in terms of functional currency. There is no impairment loss in terms of functional currency. This is because recoverable amount in terms of functional currency is higher than the carrying amount. Hence, no impairment loss is recognized. Relating to the building. No impairment loss is recognized relating to the building. No impairment loss is recognized relating to the building. Now, dear student, come to question number 20. Again, we will solve in the notebook. Question 20. Mission has carried out transactions denominated in foreign currency during the financial year ended 31st October 2016. Okay. So what is the year ending date here? Underline 31st October 16. Little unusual. Functional currency is USD. Now 3 transactions they have given. Very easy. Mission has purchased goods from a foreign supplier for 8 million euros on 31st July 2016. Okay, 8 million euro. And what is your functional currency? Dollar. So you'll have to convert euro into USD on 31st July 2016 rate, which is given below 1.6. On 31st October 16, the trade payable was still outstanding. So what you will have to do, you have to revalue at closing rate, which is 1.30, and the goods were still held by mission. So again you have to apply the valuation of inventory principle, cost or NRV, whichever is lower. Mission had sold goods to a foreign customer for 4 million euros on 31st July. So you have to pass an entry for sale on this date, and it had received payment for goods on 31st October. So payment was received at this rate 1.3. The difference is your exchange gain or loss. Creditor is not yet settled, debtor has been settled. But in both cases, you have to calculate the exchange gain or loss. Advice on how to treat this transaction in the financial statement. So line by line, we will explain each point. Okay. First is inventory. Some inventories, in this example, the entire inventory still in your stock. What you have sold may be some other inventory, but with respect to this inventory, it is still on stock. So write down inventory. Inventory will be measured at cost, which is invoice date rate. Invoice date rate. The inventory would be initially recorded at spot rate on the date of purchase. Inventory will initially be recorded at spot rate on the date of purchase. That is 1.60 euro per dollar. 1.60 euro per dollar. So write down therefore 8 upon 1.60 equal to $5 million. Okay? Or have you multiplied? At the year end, as per IAS 21, now inventory is a non-monetary asset. Non-monetary assets and liabilities are not restated. Non-monetary assets and liabilities which are carried at cost are not restated. Now they have not given us the NRV of this inventory in that currency, euro. We'll assume same. Non-monetary assets and liabilities carried at cost are not restated. So inventory stays at $5 million. But if you try the other rate, it is higher. 8 divided by 1.3 would be even higher. So therefore 5 million is okay. Otherwise it would have given rise to some discussion. So even if I take 1.3 for comparison, still that 5 million will be lower than NRV figure. So as per IAS 27, non-monetary assets and liabilities carried at cost are not restated. So the inventory stays at $5 million. What about trade payable? Trade payable, write down on invoice date. On invoice date, write down same as inventory. Don't write so much. Same as inventory equal to $5 million. Because you purchase the inventory, second effect is creditor. Same as inventory equal to $5 million. At year end, trade payable is still outstanding. At year end, trade payable is still outstanding. Monetary liabilities are restated using closing rate. Monetary liabilities are restated using closing rate. Hence, euro 8 million by 1.3. Euro 8 million by 1.3 is $6.2 million. But there is a problem. you have recorded it at 5 and now you are restating it at 6.2, so there is an exchange loss. So write down exchange loss of $1.2 million. Fast. Exchange loss of $1.2 million would be reported in SOPL. Would be reported in SOPL. Now write down next heading, goods sold. Point number 3, goods sold. Goods sold in bracket, write down dater. Dater. First, under that, write down small a, at invoice date. At invoice date, what is the euro value of that goods sold? 4 million euros. Right? So write down the invoice would be initially recorded at spot rate. Invoice will be initially recorded at spot rate, that is 1.60. Therefore, sales and receivable is equal to 4 divided by 1.60. 4 divided by 1.60 is $2.5 million. Is $2.5 million. Now at year end, you have received the amount. When you received the amount, the rate has changed. So write down the trade receivable is received by the year end. The trade receivable is received by the year end. The actual value received is euro 4 million upon 1.3 equal to $3.1 million. Gain or loss? Gain. So write down exchange gain of $0.6 million. Exchange gain of $0.6 million would be reported in the SOPL. Would be reported in the SOPL. Okay. Now we'll take a little comprehensive question where you have to solve 6 or 7 transactions at a time. Question number 21. ASF Limited, in bracket functional currency INR, has entered into following transactions. 1st April 2020, purchase machine on credit rupees 10 lakh. Now see, this is to confuse you. Your functional currency is INR. Transaction is also in INR. So no IAS 21 application here, correct? Just you will pass a normal entry like a 11th standard accounts question. Machinery account debit 10 lakh to creditor for machinery 10 lakh. And no further treatment, only for payment or depreciation or revaluation. So which means for this transaction IAS 21 is not applicable. Then purchase goods for $30,000. Yes, this is in foreign currency because INR is functional currency on credit. Spot rate is 62. So you will record this transaction at this rate. Purchases to creditor for goods. Paid to creditor for goods. Out of 30, $20,000 we paid. 65 is the rate now. So there is a exchange loss on $20,000. That also you will record. Purchase car. Car is a non-monetary asset for 40,000 and the rate is 67. But now this car is purchased using foreign currency. So here your IAS 21 is applicable. For machine it is not applicable, but for car it is applicable. First you apply this rate. Revalued car upward by $5,000. So now the value of the car will be $45,000. And now the rate is 68. So it will be valued at 45,000 into 68. Compare that with the previous carrying amount in the books, which is 40,000 into 67, and that is your exchange difference, or that is your revaluation gain. Then sold goods for $10,000, again your foreign currency, sale at 69 rupees. What about the recovery? Not yet happened. So this dollar debtor will appear in your SOFP. This creditor 10,000 is not yet recovered, will appear in SOFP. This purchase of car, is it cash or credit? Not given. Assume credit. Write down on credit. So that creditor will also appear. Car will appear in your SOFP. Machine will appear in your SOFP. Right. So the question is on 30th September 2020, the rate is 70. So all monetary items will be translated at closing rate, like 30,000 minus 20,000, 10,000 creditor here. Then this car already I have revalued. Creditor for car will be valued at 70. Debtor will be valued at 70. And we'll transfer all the exchange difference to profit and loss account. Then, revaluation reserve we will transfer to OCI. Past journal entries, and one more question. Trial balance. To check your basic knowledge of accountancy, sometimes such things can also be asked. So write down in your notebook, in the books of ASF Limited, journal entries, one full page we have to draw, in case if you are drawing the format. Otherwise, start. 1st April 2020. Machinery account debit rupees 10 lakh to vendor for machinery. Vendor for machinery 10 lakh. To vendor for machinery 10 lakh. Then 1/5/2020. 1/5/2020 purchases account debit. Purchases account debit 30,000 into 62. 18,60,000 to creditors for goods account 18,60,000. Narration is homework. 1/6/2020. 1/6/2020. Creditor for goods account debit. Your book value is 20,000 into 62, 12,40,000. Actual payment will be to bank 20,000 into 65, 13 lakh. So balancing figure at 60,000. Exchange difference account debit 60,000. Exchange difference account debit 60,000. Okay. Next, 1/7/2020. Purchased a car. Write in bracket, assume on credit basis. In the question, assume on credit basis. Car account debit 26,80,000. In bracket 40,000 into 67. To vendor for car account 26,80,000. To vendor for car account 26,80,000. Okay. Agreed? Yes. Then write 1/8/2020. 1/8/2020. Now there is a upward revaluation of car. So what you will do? First you find out what is the dollar value of this car. 45,000. 40 plus 5, 45,000. And this entire 45,000 will be multiplied by 68. Some student, what they do, they just multiply 5,000 into 68. No, 68 is applicable to the entire car. And then you deduct the carrying amount, previous carrying amount. Then the difference is your revaluation reserve in bracket OCI. Okay. 3,80,000. Come to next entry 1/9/2020. Debtors account debit to sales account. 10,000 into 69. 10,000 into 69. How much is that? 6,90,000? Yes. But the answer is not over. They have given you one last line which says closing rate is 70 rupees per dollar. In our question now we'll identify what are the monetary items. Is machine a monetary item? Yes or no? No. Is creditor for machine a monetary item? Again, the answer in this example is no, because it is in rupees. It is in rupees. Then creditor for goods is a monetary item, that we will restate. Then creditor for car purchased is a monetary item, that we will restate, and debtors we will restate. Correct? So one by one. First, creditor for goods. He has already paid us $20,000. So now $10,000 is recoverable, and the exchange rate has moved up from 62 to 70. So the entry will be exchange difference account debit 80,000 to creditor for goods 80,000. To creditor for goods 80,000. What about the vendor for car? How much is the loss there? We purchased car at $40,000 at 67 rupees rate. Now it is 70, and this vendor has not been paid anything so far. So exchange difference account debit 1,20,000. Correct? Why 1,20,000? Now the rate is 70. When we bought it, it was 67. The value of the car and the liability is $40,000. So to vendor for car 1,20,000. Now there is a debtor also. Enjoy. In debtor there is a gain. 10,000 into 1 rupee. So debtor account debit to exchange difference 10,000. 10,000 into bracket 70 minus 69. Okay. This completes our entry. Now we'll prepare trial balance. Right now we'll not transfer exchange difference to P&L account. That we will do when we prepare the final accounts, finalization. So first today we will check your intelligence. Can you prepare the trial balance? Check what are the accounts which have balances, how much is the balance, whether it is a debit balance or a credit balance. Draw two columns on the right side, debit, credit. Let the world today know your intelligence. 30 seconds will be allowed to you. Okay, check the answer. Tallied. So tick mark machinery 10 lakh. Anywhere you have written debit column 10 lakh, tick. Creditor for machinery 10 lakh, tick. In any sequence it should be there. Then purchases 18,60,000. Creditor for goods 7 lakh, credit column. Now what about the cash and bank? Is it negative 13 lakh? Have you taken that into account? Cash and bank is negative. All bank entry if you see 13 lakh. Car write down 30 lakh 60,000. 45,000 into 67. The last time when we revalued the rate was 67, that rate will be taken. Vendor for car will take 28 lakh. Have you taken 28 lakh? Then revaluation reserve 3 lakh 80,000. Credit column. Debtor 7 lakh. Sale 6 lakh 90,000. And total net exchange difference, all exchange difference put together has a debit balance of 2 lakh 50,000. Are you getting total 68 lakh 70,000? How many mistakes? Sales, one mistake. Yes, one more. Yes. See how a simple question of 11 standard sometimes becomes complicated. And these are only some 7-8 transactions. They can ask you even more. Okay, we'll try one more question. Dear student, come to one question number 32. 32. Functional currency of A Limited is INR. Year ending date is 31st of December. On 1st July 2023, A Limited purchased a machinery on credit for 4 lakh yen. Yen is the currency of Japan. Okay. And A follows historical cost accounting, underline. So that once you value the machinery, that will appear at the same rate. And depreciation is 20%. That will also be based on historical rate. On 1st November 2023, A Limited made a payment of yen 1,80,000 to the supplier. Relevant exchange rates for rupee 1 are as follows. Now exchange rate is given yen per rupee. What is given? Yen per rupee. On 1/7/23, 10 yen is equal to 1 rupee. On 1/11/23, we received a payment. Okay, so 7.20 yen per rupee. Then 1/12/23, useless. Why useless? There is no transaction on 1/12/23. And 31/12/23 closing rate. Monetary item will be valued at closing rate. Non-monetary item will not be valued at closing rate. Okay. Past journal entries. Just write down past journal entries. So write down in your notebook 1/7/23. Plant and machinery account debit. How much you written? 40 lakh or 40,000? 40 what? Lakhs or 1,000? 1,000. Lakh. 40,000 is right. 10 yen is 1 rupee. 4 lakh is 40,000 rupee. Indian rupee is more powerful compared to yen. Okay, doesn't matter. If you go to Japan, it is very expensive. Right? Once I had gone to Tokyo, it's very expensive. Vendor account debit 18,000. Now, why 18,000? We have settled 1,80,000 yen vendor. So my book value is 18,000. But when I made the payment, the rate was 7.2. So the payment is 1,80,000 divided by 7.2. So you ended up paying 25,000 rupees. So there is an exchange difference account in bracket P&L account. 7,000 is right. Out of 4 lakh yen, you have paid 1,80,000. How much is still pending? 2,20,000. But you have to also provide depreciation. So depreciation will be on the basis of historical amount only. So the historical value of this asset is 40,000, which will not change. Rate of depreciation is 20%. You purchase the asset on 1st July. The year ending date is 31st December. Therefore, 6-month depreciation is how much? Is it 4,000? Right, depreciation account debit to plant and machinery 4,000. And one more entry you have to do. You have to restate the foreign currency liability. Exchange difference account debit. Exchange difference account debit 5500. Sir, how did you get this number? To vendor account 5500. See the calculation. At the end of the year, we have 2,20,000 yen payable. The rate is 8, not 9. 9 is to confuse you. So this is the value at closing rate. And when we had bought the machine, the rate was 10. So book value in the books of account, it is appearing at 2,20,000 divided by 10. Just check this two calculation and check the difference. Is it 5500? Yes. Vendor is a monetary item. That we will restate. Plant and machinery is a non-monetary item. And the question has specified that, is it specified that it is carried at cost? Historical cost? Yes. So what you do as a homework, prepare a trial balance for this question. Will you be able to do? Prepare trial balance as homework. Now we will continue tomorrow.